So this is a lesson on our year-end adjustments. Just to revise all these year-end adjustments. The first year-end adjustments we will have a look at is trading stock deficit. Now, at the end of the year, a physical count of the stock is being done, and we need to compare this physical count to the books of the business. Now, the physical count can be less than the physical count or what is in our books of our business. Possible reasons for this deficit, it could be that errors were made during the year, like there was an incorrect calculation of the markups. There might have been theft, damaged or broken stock, stock that was destroyed, or errors in stock taking. So if our books, the trial balance amount figure, is bigger than the physical count, the stock that is physically in my warehouse, we have a deficit. The trading stock deficit is an expense. We could also have a trading stock surplus. So either you will have a trading stock deficit or a trading stock surplus. Once again, the balance of your trial balance, that trading stock figure, will be compared to the physical count. The physical count can be more than our books. Possible reason for the surplus could be that there were errors made during the year, like incorrect markups, maybe errors in stock taking, or omissions of stock purchases in the trading stock account. So that means that we purchased stock, but we did not record it correctly. Therefore, if my trial balance, the T account, our general ledger balance, is less than our warehouse, our physical count, we will have a surplus. A trading stock surplus is an income. To show the recording of this, in the trading stock account on the debit side, we have our balance from the trial balance. If a deficit occurs, that amount deficit we will need to take out of our books. We need to take it out because that trading stock that's missing, we create a trading stock deficit. This closing balance is the same as the physical count. So that's the given figure. And we will debit trading stock deficit as it is an expense account. It decreases our profits. In the general journal, you would debit trading stock deficit and credit trading stock. Your narration, trading stock deficit as per count. The next adjustment is consumable stores on hand. Now, with accounts like consumable stores, packing material, and stationery, if we use these during the year, if we use our consumable stores, we use our packing material and our stationery during the year, we have an expense, and we record it as an expense. But during the physical count, there might be unused items. So we would count our stationery and there might be unused stationery or packing material or consumable stores. If we haven't used it, this cannot be regarded as an expense at the year end. Because you can see the items, you can touch them. This becomes now an asset in my financial statements. So unused items are regarded as assets in the balance sheet. So therefore, we would create an account called consumable stores on hand. When I record consumable stores on hand, I would have my consumable stores account and I will take out that unused consumable stores or packing material. So you take out the unused packing material. So I'll credit the packing material account and I'll create a consumable stores on hand. And this is the amount as per stock take. So the packing material used for the year will reflect here in your profit and loss. This will go to your income statement. This is your balancing figure. In your general journal, you will debit consumable stores on hand. It's an asset. Credit packing material. Then we have accrued expense. Accrued expense is a liability and therefore it credits. So all the expenses for the year must be brought into account in the financial statements, even if it has not yet been paid. Because according to the matching principle, we need 12 months of income minus 12 months of expenses to calculate the 12 months of profit. Therefore, even if we haven't paid for that full year's expenses, we must still bring it into account. To explain to you, accrued expense. So here I can see my financial year. And on this red, I can see if only this is the paid expense for the year. I haven't paid for the full year. This blue part, this is the outstanding section that I have not yet paid, and therefore we have an accrued expense. This amount is still owing at the end of the year. It could be for any expense, water, electricity, rent expense, insurance, any expense account. And if I have not yet paid it, I owe that amount, therefore accrued expense is a liability. When I record accrued expense, I will debit the expense account. So for this example, we've debited insurance and I credit accrued expense as it is a liability. Then I have prepaid expense, which is an asset, and debit. So here's my financial year. My prepaid expense, I have paid too much. So this portion that's outside the timeline, this was paid for next financial year. Therefore, we have a prepaid expense. So only expenses for this current financial year must be taken into account. All expenses paid during the financial year that concerns the following year, the next year, cannot be reflected as an expense in my financial statements. Therefore, it needs to be taken out of the expenses and we create an asset. And this is because of the matching principle. So for this example, I will credit the expense account and I'll debit prepaid expenses. Then we have accrued income, which is an asset, debit. So here's my financial year. And I've only received part of the year, a section of the year I've received. This part in blue is the section of the financial year I have not yet received. This portion I've not yet received, and therefore it's accrued. All income for the financial year must be brought into account, even if the income has not yet been received. And this is according to our matching principle. Our example here, your income, you will credit the income account, for example, rent income, and credit accrued income. Then income received in advance, it's a liability, it credits. So here's my financial year again, and I've received too much. I've received for next financial year as well. So I can see I've received for next financial year, therefore I have an income received in advance. So only income receivable for the financial period must reflect. So only for this 12 months of the financial year is allowed to reflect in my income statement. If I've received for next year, it's classified as a liability, which will go to income received in advance. And this is according to the matching principle. Then finally, we're going to have a look at depreciation. Depreciation is an expense. We have two methods of calculating depreciation, the cost price method and the diminishing balance method. The calculation for the cost price method is my cost price times the percentage of depreciation they give you times the number of months over 12. For your diminishing balance method, cost price minus accumulated depreciation, multiply or times your percentage times the number of months over 12. When I record depreciation, I would debit depreciation, which is an expense, credit accumulated depreciation. Remember that accumulated depreciation on vehicles and accumulated depreciation on equipment is regarded as a negative asset because it decreases the value of my equipment.